Hi, I'm Angela Cavanaugh, the Executive Director of CAI, and I'd like to welcome all attendees and thank our partners, the Board of Directors, and the CAI team for today's program. Some housekeeping rules today. All participants will be muted. If you have questions, please type them into the question box, and if you need a certificate for manager credits, please email Jackie at Jacqueline, Jaclyn, at CAI-NJ.org. And just a note, you must be in attendance for the entire presentation to receive a certificate. I would now like to introduce Robin Insurgent, Staff Liaison to the Membership Committee. Welcome, Robin.
Thanks, Ange. Again, I'm Robin Insurgent, and I'm the Membership Manager for CAI New Jersey. I'm here today to just remind you all participating to make sure to renew your membership with us. And for those that are new with us and are not members, to please contact me about joining this great association so you can participate in all of the benefits and programs that we have lined up for 2021. For our homeowner leaders, you have access to our ADR program, which is a cost-effective way to fulfill your association's legal obligation. We want to ensure that you have the best possible boards, so we strive to bring you board training, programs, and content to make sure that you are succeeding. We have upcoming roundtables to put on your calendars. We have our manager roundtable discussion on Thursday, December 17th. And we also have a LAC roundtable discussion on Wednesday, January 13th at noon, which is free for all homeowners and managers to attend. So please be sure to visit our website and register for those roundtables. We do have other upcoming events. We have our virtual expo, which has launched. So please visit our website to see the schedule of our video releases and to see our members, and they brought their booths to you. So be sure to take a minute out of your day and view those. Also be on the lookout come January for our live streams. We also have our Wednesday webinars, which is every Wednesday at noon to join our education program, allowing one CEU for those who need accreditation. We also have our HOA feud this Friday, where our business partners and managers will battle it out for a fun little break in your day. We have our FAST committee this season are spreading holiday cheer and donating to our adoptive family, where we are adopting 2 families to ensure that they get to enjoy the holiday season through Interfaith Neighbors, which is a local Monmouth County organization. We are asking that members support this initiative by clicking on the link in this chat box and donating whatever you can. Every little bit helps, especially this season. So your help and support is greatly appreciated to bring some holiday cheer to those families this year. Lastly, if you would like to register for our community night out cooking demo, brought to you by the Women's Leadership Network on January 7th at 6 p.m., you get to cook with our guest chef, Jennifer Nevins, and make a meal for you and your family. We have a deadline to register is December 30th. So again, if you have any questions regarding your membership or any of these events, please email me directly. I'm always happy to help. Thanks.
Thanks, Robin. First with us today is Tony Lichardi. Tony has been the Director of Customer Service at Accurate Reconstruction since June of 2000. A primary focus is community association outreach and education, as well as helping managers, boards, and homeowners deal with the processes involved with disasters. Today, Tony will be discussing identifying the basic elements of a disaster plan. Welcome, Tony.
Hi, thank you. Okay, so, nobody wants to have any type of catastrophe in their home or their community, obviously, but I always think it's best to be prepared. We try to get communities to plan ahead, hope for the best while preparing for the worst. So I thought a couple little pointers, and here we go. Here we are. All right, so water can be a little tiny bit. So a tiny little leak under your bathroom sink or kitchen sink or a shower curtain that doesn't stay in, or any number of things. And I guess the key is educating your homeowners to know that needs to be like really immediately cleaned up if there's any sort of water, drying it up and getting it cleaned up to prevent like this slow growing mold, because most often insurance doesn't cover that type of mold, with some exceptions and some deductible issues or whatever. But just like letting people know the importance of making sure that that little bit of water gets cleaned up immediately, dried up immediately. The hiding places are most often sort of under bathroom or kitchen sinks, or the corners next to where shower curtains are. And then there's also lots of water, and that happens, unfortunately. So things like a burst water heater or pipes that are frozen. Oops, need to go back. I don't know how to do that. Anyway, pipes that are frozen, different things like that. So those times will often require some reconstruction and some, professional drying help. So if you have, what have I done? Anyway, does anyone know how I go back? Jeez, okay.
Tony, you can use the buttons on your keyboard, the left and right arrows, to go back.
Thank you. That makes me so happy. Okay, thank you. Tech challenged. Anyway, so that'll have to be dried, and it'll have to be professionally dried typically, and often you'll have a relationship with an emergency company like that, or if you have a good relationship with a reconstruction company, which we strongly recommend, they can help you as well, and that needs to be professionally dried. Removing wet sheetrock or insulation, carpeting and padding, things like that. And then once everything is dry, your construction company can come in and take over. Any good reconstruction company will help you through the entire process. All right, fire, the big one. So no one wants a fire. Nobody plans for a fire. Everyone hopes they never have to experience, and I hope you also don't. But it's best to have an emergency plan in place, and a little bit of advanced planning can go a pretty long way. So your people should know, your homeowners should know, your managers, everyone, board members should know kind of the best course of action ahead of time. So knowing the evacuation routes, knowing how to use a fire extinguisher in a minor little thing in the kitchen before it becomes a big fire, things like that. And having a training event, and these days that would probably be virtual, but regardless, having training events to get people to understand sort of what they would do if there were any type of fire. Often a good fire reconstruction or restoration company will help you, be very happy to help you with those training events. Develop a professional relationship with a competent professional reconstruction expert. If you know them ahead of time, you know who to call. It's good to know a couple so that you have some options, but knowing right away is great. Another thing is keeping unit owner and resident contact information with you or available easily at all times. We suggest something like a little USB drive. In fact, we sometimes give them out at trade shows, but little USB drives that you can load this information onto and keep it with you, home and at the office, or maybe it slips into your briefcase or your wallet, something like that. But that's actually pretty critical, is being able to reach people in a situation like this. The other thing is to keep your insurance agent and carrier company telephone number and your policy number handy. Another thing to put on that flash drive. You should know what type of policy your association has in place. So there are several kinds. Just get to know what it is, because when something happens, homeowners need to know what they need to cover with their own personal insurance. It's critical, and underestimated how important it is for you to know where the original blueprints for your community are located and have them available. If you happen to have the initial offering information, that can also be helpful. It helps people know what was an upgrade in their unit if they didn't buy it new. And then, of course, I'm sure everyone does this anyway, but strongly encourage all homeowners to maintain their own insurance. They really underestimate what is covered, or they overestimate, my apologies, they overestimate what is covered by the association's policy, and even something as simple as their contents and paying for where they'll live when something happens. It's not covered by the association, and they're not going to have, anything. They'll be moving in with their kids or whatever in an uncomfortable situation if they don't have it, and then starting fresh with trying to buy furniture. In addition, any of their upgrades, anything, you know, that brand new kitchen they put in or whatever, not usually covered, not often covered. So encouraging them to have it, and it's not very expensive. And that's another thing, is they tend to think it's going to be very expensive. It's really not. It's worth every penny. All right, so now you've had a fire, and obviously you're going to call the fire department. And then whatever your insurance agent has instructed you to do with regarding reporting a claim, and then call that reconstruction or restoration professional that you have established relationships with. If they are a decent, good, competent company, they will be there night or day, every step of the way. So that's the next call after you make those obvious first, most important calls. And then after that, you can just to know ahead of time what you would expect in this situation. Lots of people are going to want to come and take a look. There's going to be township officials, fire officials, insurance cause and origin people, adjusters for every unit owner that has insurance, the association's adjuster. Your contractor is going to bring in their truss engineers, their architects, and you know, their crews, and meet with the township there and everything else. So you will just expect sort of a parade of people coming through, and that's a good thing. That is what gets the ball rolling. Oops. This is information that I gave you regarding fire and water, but really the same basic planning goes into almost any kind of catastrophe you could imagine. If a tree falls on your building, or the wind rips off half a roof, or you know, there's vandalism, or someone drives their car through their garage. All of the same information applies, and it's really is best to be prepared. And as JFK said, the time to repair the roof is when the sun is shining. And that is it for me.
Thank you, Tony. There are two questions from our attendees. You touched on both of them, but obviously there's still questions. So the first one, why is it important to have a contractor I trust ahead of time and call them in early when I have a catastrophe?
Very good question. Yeah, I did touch on it, but no details. So a couple of reasons. One is when you're having the situation and you have a building half on the ground or whatever, that's not the time to start interviewing people. So knowing someone that you trust, having already looked at some of their work, asking insurance companies what they do, and if they do it well, is a good way to know ahead of time, and you just pick up the phone and you call that company, and you're not then in the midst of crisis trying to find somebody. And then bringing them in early is because they will coordinate with your insurance adjuster. Things will go much more quickly if the contractor meets with the adjuster. For example, the first time the adjuster goes and a trusted contractor is there to walk through with them, they agree on what is actually damaged, what needs to be repaired or rebuilt, and have the kind of communication that enables the settlement to be reached quickly. They agree on what kind of things can be revisited if it's hidden or what comes up. Let me just make sure. Oh, your contractor can also coordinate things for you, like utility details, getting things shut off, whether a fence is needed, things like that. And so having them involved early will just cut a lot of the time off of what will happen preliminarily. That's the main thing.
Okay, and one other question. Why is it important to have a community blueprints available at the time of the disaster?
So, couple things. One is those plans will show where all of the utility shutoffs are. So particularly with fire, but also with other things and bad floods and things. Those utilities will need to be shut off very, very quickly. And it really does differ by community. Some have shutoffs in every unit. Some have some located outside the building for the entire building. So that's one thing. The other thing is whoever the architects is and whoever else comes to investigate and look through will need to look at those blueprints. If you don't have them, the architect that comes in to do the reconstruction will have to actually start from scratch, which takes a long time. It's also very expensive. So if you don't happen to have them, you look ahead of time, you're in planning, and they just don't seem to be anywhere. A couple of things you can do are, first of all, the town doesn't usually have them. Used to be the case that they kept blueprints for projects for a certain amount of time, but if you have a 10-year-old community, they're not going to have it, and they now put them electronically for new community, brand new communities. But your original builder or architect will likely be able to get you a set. You can't use those for the reconstruction for a couple of reasons. It's intellectual property of the original architect. That's one thing. And then the other is that code upgrades, things like that. So you will need new plans drawn, but if they can go off the plans that you already have, things are much easier, much safer, and everything else. The other option would be whoever does your reserve studies and things can prepare a set. If you can get them from the original builder, that's better and cheaper.
Thank you, Tony. If there are any other questions from our audience, please feel free. We'll come back to Tony at the end. Thank you, Tony.
Thanks,
All right.
Angela.
Next, we have David Charabani. David arrived at Popular Association Banking after a 20-year career on Wall Street in sales and trading various financial instruments. In the financial sector industry, he was able to utilize his skills in sales and customer service to various institutional clients. Currently at Popular Association Banking, for the last 16 years, David has translated his experience in dealing with community associations. In working with associations and through property management firms, he is able to provide many financing solutions to these associations, funding a variety of repair projects and restorations by providing loans. Additionally, David can provide cash management services to those associations that have borrowed money for financing. Welcome, David. Oh, one more thing. Today, David will be discussing the financial planning process and the current economic environment. Again, welcome, David.
Thank you very much, Angela. Thank you all for having me. My topic is basically, I don't have a PowerPoint presentation. I'm going to talk generally, but the financial planning process. But before I get into the specifics of financial plannings for associations such as reserves, how they plan for projects, etc., I think because this year was so unusual, I'd like to just take a step back and go back from March to the present to discuss what happened and what's going on. So as Angela said, I've been at the bank for 16 years. I specialize only in associations and specifically lending to associations. In 16 years, I've seen tremendous growth in this business. I've seen everything that there is to see, but this year provided new challenges. And, you have to adapt in all careers and businesses. And I think this year was really, that was a point that was emphasized more than any since I've been working at the bank. So let's go back to early mid-March to April. The phone was ringing more than I ever saw before. And I wasn't surprised, but there were a lot of property managers especially, but other vendors calling saying, what's going on? Is the bank going to shut down operations? Are you going to lend, etc.? We didn't know any of these answers, to be honest with you, just like, the general economy. But what happened after the initial shock is that we saw associations coming to us asking us questions. These are existing loans that we had on the books. So they wanted to be proactive. Nothing had happened yet, but they were a lot of associations were anticipating that unit owners would have trouble paying their maintenance payments. The life flow of an association is the most important aspect. Obviously, if income doesn't come in, the properties can't be maintained. We did see some of this, but associations, like I said, were being proactive. They were coming to us without seeing these problems yet, asking for deferments on their loan payments. In other words, they were asking to actually stop payments altogether for a period of time, or, as you know, as a loan goes through its life, you're paying principal and interest. They wanted to change the structure to interest only. to save themselves on a big expense on their income and expense report. We were doing this. If I had to quantify a percentage, I'd say about between 2 to 3% of our loan portfolio came and asked for these deferments, and we gave it to them in all respects. A lot of these associations also were going for PPP loans. The eligibility of associations was in question. To us, it was a very gray area whether they could do it or not, but it really wasn't ultimately our call. If they maintained the PPP loan, we would let them do it as a second position on note. So I would say basically the deferment and the risk rating that the banks looked at these loans changed. So basically, we have a risk rating assigned to these loans, which enables us to price these loans, etc. The bank raised the ratings on all of these loans, no matter what the financials look like at that point. I would say after that initial shock, we went through something really surprising here, which surprised us, and I've spoken to all my competitors. We had a record demand in 2020 for loan production. We had a record amount of associations coming to us for loans. Why? I think there were two reasons. One is associations looked at these projects, and I think they got more serious about getting them done. They were afraid of property values decreasing and a lot of other reasons. So I think they wanted to raise cash quickly. And the second most important reason, how do you pay for these projects? Either sitting reserves or assessing the unit owners or a combination. And I think for both those factors, especially assessing the unit owners up front over a 12-month period, associations did not want to do that. So a bank loan gave them the ability to pay over 10 or 15 years to much lessen the impact to unit owners to pay for these projects. So it was a combination of that, and I would say associations looked more seriously than they normally would on doing projects that were necessary. I think there was a fear generally out there the first half of the year that they would have trouble finding loans from banks. So there was a big rush to go to banks to say, are you lending? Can we get a loan, etc.? We want to do this project now. And also in New Jersey especially, they shut down actual construction unless it was for emergency purposes. So people didn't know in the beginning. They were thinking the worst case scenario. Can we do, we have a retaining wall that's failing. The siding has water infiltration. Are we going to be able to address these projects, or are we going to look down the road a year from now and we couldn't get financing, we couldn't actually do the construction, and the deterioration of the common element got even worse and we're in worse shape. So everybody wanted to jump the gun. That's really where we were, and we had a record amount of demand. I would say from the banks' end, we had federal examiners coming in and also our internal auditors coming in, taking a hard look at our portfolio. Our loans, as you know, are the collateral on our loans. These are not real estate loans. There's no mortgage to the association. So I'll take a step back. The way we collateralize these loans is we take an assignment of the income flow coming into the associations, which has worked for us for 20 years. We don't have an outright default. But credit came in and federal examiners and looked at these loans as unsecured by any real estate. So they took a hard look. They wanted to see basically where we were with these loans, where the deferments were. We had to get a lot of documentation from associations to make sure going forward that our loan portfolio could remain with the same health status as it did before the pandemic. And I would say in general, although managers have talked more about this than I would say associations initially may have had a little spike in delinquencies in arrears of maintenance payments, but we're not seeing that now. I think everything has settled down. It's almost gone back to status quo. Of course, there are some unit owners that are unemployed that may not have happened prior to COVID, but I think the general health of associations is basically where it is right now. Just going back to what I said about examiners, our credit matrix, in other words, all the variables involved in these kind of loans were re-examined, and we had to re-justify all the reasons that our loans are on the books for all our credit parameters. I would say going forward, before I go forward, I would say that really is a summation of what went on. We were very surprised in the beginning with some aspects, but some were normal as far as, associations being cautious and arrears. But I'd say as things settled down, basically we're back to where we were pre-pandemic as far as associations' health in general. Going forward, I'd say just looking at loans and reserves. I'll talk about the loans first. We are seeing right now, though, there's a lag of interest rates rising slightly. We don't know if that's going to continue. It's impossible to forecast rates. In the beginning of the pandemic, we saw record low rates, and the cost of funding almost went down to zero for commercial institutions. So that also, getting back to the first half of the pandemic, caused a lot of associations to run and try to secure in record low rates, which we're still in that environment. Rates are creeping up right now. There's a variety of reasons for that. Politically, appointments at the Federal Reserve, I don't want to go into that because I can't forecast rates. We don't know where they're going to go. But I would say there is a lag. Rates are currently inching up slightly. If that continues, I think you're going to see commercial rates rise. To what extent, we don't know yet. There's just so many unknown factors involved. I think 2021 is really going to be a different situation than we saw in 2020. Associations are using an abundance of caution with reserves right now. I think a lot of associations are tied up in time deposits, meaning certificates of deposits or any other kinds of safe investments. I think a lot of them are coming and looking, especially on my end, to get into liquid assets. In other words, assets that they can access at any point without restriction. We do have some associations coming to us for release of deposits that we hadn't seen in the past. So I would say, associations in general always have to have conservative deposits. They need to be in something that is risk-free from the markets, either at a bank, money market fund, a demand deposit account, or a CD. I would say that what has changed is the situations are, I would say, looked at this point more closely. As you know, why do associations come to banks for loans to begin with? It's because they don't have proper reserves. They didn't have the proper budget for maintenance income after covering their necessary expenses to save or fund a reserve study. It's as simple as that. I think funding of reserve studies and actually putting money away for a rainy day has become an issue that is more closely looked at. And I think that most associations going forward, I think until the COVID situation fades, which could be years from now, I think you're going to see associations look at reserves and health in a more prudent fashion than you have seen in the past. I do. I think this was a game-changing moment in our industry in all respects. But from my end, that's what I'm seeing. So I think that, to summarize, we're really looking at associations addressing important needs, the aesthetic parts of the association, such as, I know it's an important subject, but the pool being open, etc., the pool being maintained may not be looked at as important as water infiltration on the siding or the roofs, or etc., or something as necessary as that. I'd even go as paving as not being as necessary a project as the others. And I'd say really that's my presentation at this point. We have seen a really, really changed environment, as I said, but you're rolling with the punches. And like I said, if you would have asked me 9 months ago, I didn't know what was going on or how this would be affected. But you have adapted to the situations and the requests I'm getting from the professionals in the industry. I'm seeing as the adaptations taking place in all respects. So with that, I would say basically, if anybody has questions, I'd be glad to answer them.
There are a couple of questions. Thank you, David. The first one, how has COVID affected lending and banks' position towards associations?
I would say from the bank's perspective, as I touched on before, we're probably right now being more cautious, but like anything else that we're seeing now, I think that there will be a lasting effect on things that we didn't see in the past. So as I'm saying, we're looking at credit matrices or how we evaluate these loans more closely. I think after COVID, I don't think these things are going to go away. Associations are aging, as we know, and we're dealing with a lot of older communities. Of course, there's always new construction, but just the nature of the fact, we're lending to associations that are now 40 years old, whereas when I started in this business, we didn't see that. Associations were 20 years old. So I think that I think COVID will make credit restrictions, not that we won't be lending to associations. I think that the demand and origination are going to be there, and we'll be setting record numbers. I think the process may be a little more stringent than it was in the past, to answer that question.
So that actually leads into the next question. What is the process to get an association loan from a bank that specializes in these loans?
I
The
would say
specific process.
that's something that hasn't changed over COVID. It's basically a two-part process. I'm going to get a request that usually comes from a manager most of the time or a board member. And we'll have a discussion for about half an hour, basically what's going on, what is the project, what do the financials look like. They will have sent me their most recent interim financials and their latest audit so I could see the health of the association. But we're going to look at that and discuss it, and then basically the timing of the project and what kind of structure they're looking for, what kind of loan, a line of credit, how long they want to pay us back. That's the first part of the process. So the discussion, and then if they're interested to move forward, an association it's a two-part process. They have to apply for a loan, meaning they send us what's called a loan package. It's about a dozen items stating all their financials, their audits, a unit owner roster so we can see rentals, and then the project budget. What is the project? How are they going to spend the money? Let's see the contractor bids. That's the accumulation of the loan package, which we sent to our credit area, and the credit area takes about a week to 10 days to analyze that to give them a credit decision. If they're approved for the loan, that's the end of process one. We send out a commitment to the association for the amount of money they need. And the second part is to close the loan. So if the association is interested in the offer, they send back the fees, the loan fee, legal fees, etc., to start the next process to close the loan. That's between the association's attorney and the bank's attorney. So a checklist of items goes out from our credit area to our bank's attorney. Ultimately, the process ends when the association's attorney sends loan documents. The bank's attorney sends loan documents to the association's attorney, and he writes an opinion letter blessing the transaction. He or she writes an opinion letter blessing the transaction, and the loan closes. So it's a two-part process: credit and then closing. I would say when an association first reaches out to the point that the funds are available, it's usually about 6 weeks as a minimum. So they're going to come to us. If a project's starting in the spring, let's just say March, April, they're going to come to us at the end of the year. So they have plenty of time to get all of this done.
Okay. There are a few other questions. Let's see. With the CD rate so low, would it be prudent to self-finance a project? Thinking specifically the capital reserve making the loan to the deferred maintenance reserve at a rate higher than CDs, but lower than the banks.
Well, that's a question that's interesting. I can't really advise associations what to do. The bottom line with rates is if you're looking to fund a project by not using reserves or assessing, this is the cheapest you'll ever see money right now. It's as simple as that. So if you're looking, there's two ways to skin the cat here. They can basically use reserves or assess the unit owners or go to a bank. If you want to choose the latter, going to a bank, you're never going to find cheaper rates. So, I'm implying if you're looking for cheap money, now's the time to do it. But again, I can't forecast rates. We don't know what's going to happen. We just don't see rates will practically. The 10-year Treasury, which is a barometer for interest rates, just like the Dow Jones Industrial Average is a barometer for the stock market, the 10-year rate at the bottom of the height of the panic of COVID went down to about 0.30%, to give you an example. Today, it's at 0.95%. So it's translated to lending rates being as a low of the low threes to right now mid threes to the upper threes. I don't see association loans ever going below 3%. So this is as cheap as you'll ever get money right now. To give you a historical example, 5 years ago, these rates were in the 5s and 6s. So we just don't see cheaper money than there is right now.
Okay, and thank you. We have time for one more question. With insurance companies not covering COVID-related claims, do you anticipate the associations will be borrowing to pay the potential claims and possibly setting up a claims fund?
You're talking to me? I'm sorry. My apologies.
Yeah, I'm sorry. Yes, I'm sorry. Yes. Well,
Okay, so,
I would think this is for you. Yes, this is definitely for you. Unless,
yeah,
Connie,
so
you can
basically,
weigh in on it since it's regarding insurance. But yes, I believe, David, this is for you.
I think what you're really getting at is if an association has an insurance claim that's not paid yet, so they're looking almost for a bridge loan, yes, we could lend for something like that. Absolutely. And we would take, it's like any other common element. So we could take something that's not tangible, like the siding or et cetera. We can take an association's claim. We've done that in the past. For example, in Storm Sandy, we originated a lot of loans in anticipation of the time period of getting made whole from insurance companies. There was a lag of about a year between the actual event and when they were made whole by insurance, and we gave those kind of loans out. I would say in general, those loans are not going to be as longer term because the bank wants to be out of the picture. If there's an insurance claim and that's not settled within 12 months, 18 months, then there's a problem. So we want to be paid back. So that's not a loan typically that we're going to put out there for 10 years. It's going to be a loan with a shorter term of, I'd say, 3 years, 4 years, etc.
Thank you. All right, I'll go through all the questions we have time for now. If any of our attendees have other questions, please feel free to email me or Jackie, and we'll definitely get you in touch with the speakers. And thank you both. And we have one more webinar next Wednesday, and that'll be it for the year. Thank you, everyone, for joining us today.
Thank you, Angela.
Thank you for the opportunity. I
Bye-bye.
appreciate it.
Bye.
Bye-bye.
Bye.